You can ironically turn a very safe investment into an unsafe one by overpaying for it. An example that I point to, everybody's talking about Nvidia or the big tech, but I point to Costco. Costco is trading at 55 times earnings currently, despite being a 40-some-year-old, retailer. And Costco is a wonderful company. It's one of the few companies that is liked by shareholders, employees, and customers. I expect Costco to be doing amazing 5 or 10 years from now, but I would never pay 55 times earnings for Costco. It's hard to invest. It's hard to operate a business when real rates are so high. But as that comes down, and they're able to do it without kind of killing their currency because the US is cutting alongside them.
When the Federal Reserve starts to lower interest rates, it's typically aiming to stimulate the U.S. economy. Lower rates make borrowing cheaper, which can encourage spending and investment. However, there's a downside. Lower rates also lead to reduced returns on investments like U.S. bonds. As a result, investors often seek better returns elsewhere, frequently in global markets. Historically, and as discussed by LYN ALDEN in a podcast with Anthony FAS, this trend has been evident in various ways. For instance, after the dot-com bubble burst in the early 2000s, the Fed's rate cuts led to a surge of investment into emerging markets in Asia and Latin America, which offered higher growth and better returns. Similarly, during the 2008 financial crisis, investors shifted capital to countries like Brazil, India, and China, which provided higher yields. LYN suggests that if the Fed cuts rates today, money may flow towards economies with stronger growth or higher interest rates, such as those in Europe or Asia. Geopolitical factors, such as trade tensions and political stability, also play a role. The reason behind rate cuts is crucial. If they're due to U.S. economic troubles, more capital may move abroad, while preemptive cuts might have a less significant impact. Understanding these trends can help you make more informed investment decisions, especially in a globalized market.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
So I'm looking at a lot of the countries I would consider like mid strength. So there's some that are really strong, like India, that don't have a lot of dollar-denominated debt, and they've been already doing quite well, and they're quite expensive. So around the margins, this capital rotation is probably not going to benefit them that much because they've not really been harmed by the prior cycle. Whereas the Brazils of the world, the Colombias of the world, the Malaysias and Indonesias of the world, that kind of mid-level of strength where they have dollar-denominated debts, but they also have decent reserves, and they've been able to hang in there against a strong dollar. They've had so many headwinds that now if they finally do get a tailwind, they're kind of like cold springs that are ready to pop up. Then we look further down the risk spectrum toward frontier markets, like Egypt, for example. Egypt has a pretty significant currency crisis, a pretty significant balance of payments problems. If you do get a weaker dollar, markets like that could have a really big jump, but I'd be more concerned around the sustainability of that jump because they're just more structurally impaired. So for me, I like that mid-level. China is kind of on its own right now because doesn't have much dollar-denominated debt for its GDP. Instead, it's mostly a question of Chinese economic policy, which is to say, they can inflate their way out of their current malaise anytime they want to, kind of like the U.S. did during and after COVID. The question is, do they want to or not? So as long as they're kind of playing it more conservative, we probably should expect a malaise in China for a while. But whenever the winds change there, they have a lot of fiscal tools they can do to really kind of pump things up. And they could shift from the housing driving a lot of their growth to more other types of consumption. The offshoring and automation of the past 40 years was a very powerful disinflationary force, right? So instead of Americans in like Detroit making cars, you offset that to Japan, which at the time, especially back then, was cheaper. And instead of making, sneakers in the U.S., you make them in China, in Vietnam, and Bangladesh, and all that. And you automate it, so one person can do the work of 4 people because it's automated. We've already automated a lot of blue collar work, or put it into cheaper labor markets. And basically, what AI can do, I think, in the investable time horizon. So I'm not going to think 20 years from now for AI, but let's say the investable time horizon of 5 to 10 years, it can start to chip away at white collar work. It can one white collar employee can do the work of more because they have a bunch of AI assistants kind of automating some of their repeated tasks, um, and kind of offsetting some of their analytics or their thinking or things like that. Um, a lawyer doing legal research, having AI helper, it makes things a lot more efficient. So I think that we could see a similar phenomenon to white collar labor as we saw to blue collar labor. I think robots are an energy intensive, challenging thing, right? I think that's robots in kind of the natural world is a longer term thing, but I think that the automation of white collar work is a lower hanging fruit for now.
Lynn further explores how weakening dollar might affect emerging markets. She suggests that while India might not benefit significantly due to its strong performance and low dollar debt, mid-tier countries like Brazil, Colombia, Malaysia, and Indonesia are well positioned for growth. These nations, which have struggled with a strong dollar, could see a robust rebound as the dollar weakens. Lynn also mentions that frontier markets, such as Egypt, might experience a temporary boost, though their long-term stability remains uncertain. China, operating within its economic cycle, could potentially improve its situation if the government changes its policies, but for now, it might remain stagnant. Overall, Lynn believes that mid-tier emerging markets are the most likely to gain from current global financial shifts. Additionally, Lynn highlights that while automation and offshoring over the past 40 years have significantly cut costs and boosted productivity in blue-collar industries, the next wave of automation is expected to impact white-collar jobs within the next 5 to 10 years. AI could enhance white-collar workers' efficiency by handling repetitive tasks and assisting with complex processes like legal research. Let's return to the interview and watch more clips to gain further insights from LYN ALDEN.
This whole period is probably going to be more energy intensive because the latest technical trend over the past 15 years was towards social media and mobile internet, which is not particularly energy intensive. It's software APIs. It's fairly low bandwidth. It's fairly low hardware intensity, and it offsets some real world things. Like you don't really need to buy a printer scanner anymore if you can just scan things on your phone and sign things online. So you're actually offsetting some other things. You fold like 30 different products into your phone, and you use those other things less or not at all. So it's kind of a displacement effect. Whereas if we start really building up a lot of compute resources, that is more hardware and energy focused, intense. And so I do think that that there's going to be pretty significant energy demands over the next 5, 10, 15 years. And there's going to be, and that's an investment opportunity, but it's also a risk because that's a source of inflation if energy supply does not stay ahead. And I think that's a pretty big risk. And in Europe's case, I mean, at first glance, negative energy prices sound like a good thing, right? It sounds like abundant. But Europe has higher average electricity prices than most other places, even though they also have a pretty high frequency of negative energy. Basically, you can think of negative energy pricing as inefficiency. It means you're producing electricity precisely when you don't want it, right? So it's not about how much electricity we produce. It's about producing electricity when and where we want it because we can't just teleport it for free anywhere, right? So when we wake up, we all use a lot of electricity, and then when people commute and go to work, they might use less electricity at home, and it's those workplaces that are on. And then in the evening, they come back and use a lot more electricity again. But really, for them, it's more been like the economic power. They produce so much electricity, and then they use it to produce so many physical goods, and then they have all the logistics, all the shipping ports, all the railways, all the highways, to kind of all the pieces coming together, right? So when we think of like in the US, they think of reshoring, they think of it as building manufacturing facilities, but it's not just that. It's building, it's kind of redoing your whole electrical grid to be able to do that. And then also there's human capital, right? So in the United States, we've so deindustrialized ourselves that we have good technicians, but we don't have enough good technicians, right? And it's hard to, you have to kind of people kind of learned over decades, don't go into manufacturing, go into finance, go into healthcare. And now when you need more people in manufacturing, that takes years to build up very experienced technicians in large numbers that kind of run these automated facilities. And China, on the other hand, has a tremendous amount of human capital in logistics and in manufacturing. And that's not something you change in a year or two or three. That's a generational change. So that Europe's got Europe's got a lot of human capital in that area, but they've been hampered by their energy side. And in the US, we have the energy to some extent, but we don't really have the human capital in that area anymore. And so those are very long rotations.
Higher immigration for that moving forward, but that's has other challenges if you get too high immigration, obviously, as we've seen.
Especially if you're talking about very experienced technicians. It's different than just the number of people involved. It's people that have been being a technician for 5 or 10 years, right? It's that kind of build up expertise that you can imagine. I mean, China's been this like manufacturing powerhouse for like 30 years, and they've got a large number of very experienced technicians.
LYN highlights that while recent technological trends like social media and mobile internet have been energy efficient, future advancements are expected to demand significantly more energy, putting additional stress on our energy systems. In Europe, negative energy prices reveal inefficiencies in managing supply and demand, impacting industry costs and leading some manufacturing to relocate to regions with more reliable energy sources. Meanwhile, China has swiftly expanded its manufacturing sector, particularly in the automotive industry, leveraging its vast energy resources to lead in global markets, especially in emerging economies. Digital technologies are transforming societies by enhancing global communication, improving access to information, and creating growth opportunities. They contribute to advancements in health, climate action, and poverty reduction while driving economic growth through new markets and job opportunities. However, concerns about privacy, data security, and the digital divide persist. Addressing these issues is crucial to ensure that technological benefits are widely shared. As we move forward, it's important to consider the ethical implications of technology on jobs and personal rights. Navigating the impacts of federal rate cuts, global market shifts, and technological advancements requires thoughtful consideration. Share your thoughts on how to approach these challenges in the comments below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.